All right, as you can see, I'm not in my studio. I'm actually visiting my brother in Germany, but I really wanted to make this video for you because it is earnings season, and most people approach earnings season completely backward. They try to guess if a company will beat or miss expectations. Will Apple go up? Will Microsoft go down? It's basically a coin flip. You see, I don't predict stock moves. I don't analyze earnings reports, and I definitely don't gamble. Instead, I sell fear when it's overpriced. And in this video, I'll explain exactly how it works. I'll explain why this works, and I'll show you a real life example. It's actually a trade that I did just a few minutes ago. Plus, you will get my exact rules for trading this strategy. So let's get started. You see, during earnings season, the real money isn't made from predicting earnings results. It's made from understanding how predictable human behavior creates a pattern that you can exploit over and over again. Think about it like hurricane insurance. When a storm is approaching, what happens to insurance prices? Well, they skyrocket. Then what happens after the storm passes? Well, those premiums collapse. Earnings announcements work exactly the same way. Before earnings, investors panic and they try to buy insurance in the form of put options. And this drives option prices through the roof. And after earnings, that fear disappears. And so does the value of these expensive options. And that is our edge. So we don't predict the weather. We sell overpriced insurance before the storm hits. Now, I call this the Earnings Volatility Crush Strategy. And I'm targeting around 1% return in just 1 to 5 days by capturing the collapse in option prices that happens after earnings report. And here's exactly how it works step by step. Step number 1, identify stocks with upcoming earnings. Well, you can use a scanner like the PowerX Optimizer, which I like to use, or Earnings Whispers or Bar Chart to find companies that report earnings this week. Now, when it comes to these companies, I'm very picky. I only want high quality liquid companies. You want to look for large liquid companies where options trade actively. Think Apple or AMD or Microsoft or Starbucks. And here are my criteria for candidates. First of all, I want to make sure that they have a market cap over $2 billion. Number 2, I want to make sure that they're paying a dividend. Number 3, I like to see a PE, price to earnings ratio, under 100. Number 4, I want to make sure that they have been profitable in at least 4 of the 5 past quarters. And I want to see that the stock price is between 15 and 250. Now, based on these filters, here are some candidates for the week of July 21st through 25th. As you can see, those aren't random penny stocks. These are solid companies that move markets, but only temporarily. Now, step number 2, check the expected move. The market already tells us how far a stock might move after earnings through something called the expected move. Let's use DHI as an example. The current price is $131.80. The expected move is $5.63. So this means the expected range is $124.38 to $139.23. Now, this range has a 68% probability of containing the stock price by Friday's option expiration. This means there's a 16% chance it moves higher than expected, and there's a 16% chance that it drops lower than expected. So this means that you have an 84% probability that prices are staying above the lower range of the expected move. Pretty cool, isn't it? And the best, you can usually find the expected move in your brokerage platform, or you can calculate it yourself from an options chain. Now, step number 3, sell a put option below the expected move. So here's where the strategy gets powerful. I don't sell options at the expected move. I go even lower for extra safety. For DHI, I might sell the 123 put, well outside of the expected range. Now, that extra cushion stacks the odds in my favor because we also have the volatility crush where overpriced options lose value immediately after earnings. And when we combine both, the extra cushion below the expected move and the volatility crush, well, then I'm getting a real world probability of success of above 90%. So, as you can see, I'm not relying on direction. I'm letting the math and fear premiums do the work for me. Anyhow, so when I'm now selling the put option, I collect a premium. So let's say it's $1.30 per share or $130 per contract. Now, in this example, I'd sell 8 contracts and receive $1,040. Here's the deal. My bet isn't that the stock will go up. It can even move lower. My bet is simply that it won't crash beyond my strike price. So why does this work so consistently? Well, because options are extremely overpriced before earnings due to fear. And after earnings, regardless of whether the news is good or bad, that fear premium disappears like a snowman in the Texas sun. You get the idea. All right, let's move on to step number 4. Wait for earnings and then try to close this option early. You see, the day after earnings is where the magic happens. That 130 put might collapse to 15 cents in just a few minutes. And my exit rules are simple. Number 1, if I can close at 90% of max profit immediately, I'll do it. In this example, it means to buy back the put at 13 cents or less. Number 2, if I can't do this, I close the trade 60 minutes after the markets open for any profit. Number 3, if this doesn't work either, I try to close the trade at break even or a small profit before the option expires. You see, the goal is to avoid assignment by closing with at least a small profit before expiration. However, in the rare instances when I do get assigned, I'll manage the trade as discussed in the video Get Paid to Wait, and I'll link to it in the description because I don't want to repeat everything here. Okay, long story short, in most cases, I lock in profits within 24 hours. The idea is to take money off the table and move on to the next trade because we need to move on to step number 5, and that is rinse and repeat. You see, during earnings season, you'll find dozens of these setups every single week. And as you have just seen, I'm not trying to hit home runs. I'm making consistent base hits. 1% gains that compound quickly to 60% or even more annually. And this is why this strategy perfectly fits my SRC profit model. Number 1, it's systematic because I'm using the same rules every time. I find earnings, I sell below the expected move, and I capture the decay. Number 2, it's repeatable because I have several opportunities every week during earnings season. And number 3, it is consistent because I'm not betting on direction. I'm just profiting from predictable behavior, which creates an edge for me. Okay, so now let's talk implementation. So here's an action plan to turn earnings into your personal income stream in just, 20 minutes a week, maybe 40 minutes a week. Okay, so the setup. Do this once before earnings season. You first choose the scannings tool. I like to use the PowerX Optimizer, but you can use Think or Swim or Bar Chart or any tools like this. Now you set up the filters for high quality candidates, and you can use my criteria that I mentioned before, or you can use your own criteria. You get the idea. During earnings season, now here's what you do pretty much every week or even every day. Step number 1, you scan for candidates. So you filter for earnings announcements that are scheduled for this week. Step number 2, you pick your target and the expected move. Choose one stock, find the expected move using an options chain or an earnings calculator, and then go 1 to 2 strike prices below the lower bound of this range. Step number 3, sell your put. Simply sell a cash secured put expiring the same week. Target at least 60% annualized ROI for selling options and use defined capital and select your trade size. For example, $10,000 per trade. Now, step number 4, post earnings, close early when the premium collapses. Check the position in the morning after earnings, and if the stocks stayed above your strike, close the trade at the exit rules that I mentioned earlier. This way, you free up the capital for the next trade. All right, so what can you expect? Well, historically, the winning percentage is 90 to 92% when you place the trades conservatively. In fact, this year alone, we have placed now, 45 trades with our mastermind members without a single loss. Now, will this perfect streak continue forever? Of course not. But the math is clearly in our favor. And as you can imagine, so far, I'm very happy with the results. Okay, now let me save you some pain by sharing the most common mistakes that I see. Mistake number 1, selling puts too close to the expected move. Stay well below the range. Don't get greedy with strike selection. Mistake number 2, ignoring earnings history. Avoid stocks with a history of wild post-earnings swings, so don't trade any biotech or meme stocks. Mistake number 3, holding to expiration no matter what. Don't do that. I mean, lock in 80 to 90% of profits early. Don't gamble for the last few pennies. Take your money and run. Because remember this, nobody ever got broke taking profits. All right, mistake number 4, trading every earnings opportunity. Don't do this. Be selective. Quality over quantity. Use the criteria that I mentioned earlier as a guideline. And mistake number 5, oversizing your first trade. If you're new to this strategy, start small. Even one contract builds confidence and gets you familiar with the strategy. And as you get more experienced, you can then increase your trade size. So there you have it, my complete earnings volatility crush strategy. And if you enjoyed this video, then check out my video, Get Paid to Wait, where I show you how to use a very similar approach year-round, not just during earnings season. And I'll link to it in the description. And as always, please share this video with someone who might find it helpful. And I'll see you in the next video.